Many of the small businesses that I have been around don't make use of a simple tool, the cash forecast, that can provide them with some restful instead of sleepless nights worrying about bills. I really don't know why, because a cash forecast, as you'll learn in this lesson, is not that difficult to prepare once you know how. Other names used to identify this tool are a cash budget or cash projection. Cash is a business's most precious asset. Managing cash flow is one of the most important tasks every top manager and business owner must be able to understand. Believe it or not, many businesses have had to shut their doors not because they weren't making a profit, but because they weren't managing and controlling their cash. Profits and cash flow are both critical elements needed for a business to survive and be successful. Good cash management is also just as important as making a profit. Great cash management is even better. Good projections and accounting records are important tools for the success of a small business. While outside accountants are sometimes necessary to help, you can save some money by producing your own projections. What is a cash forecast? A cash forecast is simply a tool that a business uses to plan how much and when is money coming in and from where source, how much and when is money going out and for what types of payments. In other words, a cash forecast is just an estimate of your business's cash inflows and outflows over a certain period of time. Cash coming in is called a cash receipt and cash going out is called a cash disbursement. If cash receipts are greater than cash disbursements during a period, the business has what is called a positive cash flow. On the other hand, if cash disbursements are greater than cash receipts during the period, the business has what is called a negative cash flow. We'll elaborate a little. A cash forecast identifies when cash is expected to be received and where this cash will come from source, and also when it must be spent to pay bills and debts and what the payments are made for. Creating a cash forecast requires you to make reasonable estimates about what will happen in the future. In order to help predict the future, historical data, when available, is used and modified to reflect future expectations. For new startup businesses, an analysis of similar businesses and current market conditions provides help in preparing the needed estimates. Factors to consider when preparing the estimates include competition, local economic conditions, and the business's financial structure, capacity, and capabilities. Cash forecasting and planning requires experience and judgment in order to determine such items as expected sales, purchases, and operating expenses. A cash flow forecast or budget can be prepared for any period of time, a day, week, month, year, or even many years into the future. I recommend that you at least prepare a one-year budget by month. It should be reviewed and revised periodically to reflect actual performance and any changes in plans. By using this tool and analyzing your projections, you can see the fluctuations in cash flow and take corrective actions to avoid potential shortfalls. I'm amazed at how many small businesses don't take advantage of this simple tool that I consider one of the most valuable tools management has for monitoring, controlling, and changing the day-to-day operation of a business. Are you one of them?